come to this particular question, a very beautiful question of its class, and you'll need to pay more attention to understand this particular question. Now see, first of all, this is ONGC has agreement approved by the government with the following foreign companies, and they provide services and facilities to ONGC in connection with oil extraction business. Okay, so these particular provisions straight away comes in the presumptive type categories, where ONGC is an Indian concern and these are the foreign companies. So foreign companies are providing facilities in connection with this to ONGC. Okay, so if you see these particular provisions, 44 BB provisions, okay, and you need to pay a little bit extra attention. Here if you note, the government is also approved that particular agreement. Okay, assessee being a non-resident, in our example it's a foreign company, so foreign company be non-resident, engaged in the business of providing facilities etc. in connection with this extraction production of mineral oil. Now ONGC is in this particular industry. In that case, these non-residents income will be covered by a presumptive rate. Okay, you will not get the benefit of any carry forward set off. Okay, and you may claim a lower profit provided that the conditions here are satisfied. Okay, so now here we are not talking about lower profits. Okay, now see, what will be the income of the non-resident? Understand this. So in our example, the foreign company has got some income, see how much, 90 crores. Okay, so it will be 90 crores multiplied by 10%, because that is your presumptive income, that is 9 crores. So 9 crores is straight away going to be your net income out of this particular activity. Very simple as that. Okay, however, ONGC is paying 90 crores to the foreign company in our example. Okay, however, if the ONGC also pay the tax of the foreign company, so basically ONGC, supposing if it pays tax-free income of 90 crores, technically there is nothing like tax-free income here, but the parties interested understand that this is tax-free income. So 90 crores is net payment to that foreign company. Okay, and if you pay the tax of the foreign company to the Indian government, ONGC is making the payment. So how much is ONGC is paying? ONGC is paying 90 crores plus the amount of tax. Let me say amount is X. Okay, so whatever the taxes that this particular ONGC pays will also be the part of the income, because ONGC is paying 90 crores to the foreign person, plus foreign persons, whatever the tax liability comes, that also ONGC pays. So income of the foreign company in the given example will be 90 crore plus X. Have you understood that? Okay, however, this payment of tax can be regarded as exempt if the conditions of this particular section 10(6)(a) are satisfied. Now understand these particular conditions of 10(6)(a). Okay, so normally what we understand is income will be 90 crore plus X, assuming that X is the amount of income tax. Okay, this is going to be the gross income of the non-resident. Okay, and of that you multiply with 10%. This is going to be the net income, and on that you have to calculate the tax liability. Okay, now if the conditions of this particular section 10(6)(a) are satisfied, in that case whatever the tax on such income payable is exempt. Whatever the taxes so paid will be exempt under section 10. In other words, this X will not have to be added because it is an exempt income. Okay, I will not do that particular adjustment if the condition of this particular section are satisfied. And the section is that if in case of a foreign company, see our example, it is a foreign company, okay, receiving any royalty technical fees, it is receiving royalty technical fees, from government or an Indian concern. In our example, it is ONGC. Okay, agreement made by foreign company with government or Indian concern after 76 and before 2002. Okay, so if it is an agreement after 76, before 2002, and agreement is in relation to the industrial policy of India, in other case, the agreement is approved by the government. In our situation, it is already approved by the government. Is that very much clear? Okay, so this condition of section 10(6)(a), whether satisfied or not, let's go back to the question. It is, see, after 76 and before 2002. Okay, so after 76, before 2002. Okay, so 10 June is after. Okay, so that is not coming within first day of June 2002. Okay, so this is 10th of June. Okay, so 10(6)(a) benefit in any case is not applicable to the INC. Okay, for A and B, 10(6)(a) benefit, if available, if it is coming, if ONGC is paying the tax, then 10(6)(a) benefit can be available. Because that also we have to see. So 10(6)(a) will come only when if the taxes are paid by the ONGC. Otherwise, the respective foreign company has to pay the taxes from their own pocket, because it is their own tax liability. Okay, so in the given case, now we will have to see, find out the taxable income and the tax liability of the foreign company. Okay, that will do. Discuss tax liability borne by the ONGC would be perquisite arising to B and C. Okay, so that is B and C. Okay, if the tax liability is borne by the ONGC. Now for AINC, there is no question of 10(6)(a) coming, because ONGC is not paying the taxes of AINC. AINC has got income of 90 crores gross income. So AINC will do its own computation and AINC will pay its own taxes. So their 10(6)(a) application will not come into picture, because ONGC is not paying the taxes. Okay. Now in case of BINC, 10(6)(a) benefit will be applicable. Okay. However, whatever the taxes that the ONGC is paying, that will not be taken into account for the purpose of doing the gross income calculation. So my gross income itself will be 90 crores. Okay, so I will not take 90 crore plus X. Okay, 1 second, let me erase these few things now. Okay, see, AINC will be, income will be 90 crores. So 90 crores into 10% will be the net income. So it will be 9 crores will be the net income of AINC. Okay. Now with respect to BINC, logically it should be 90 plus X, but the X is exempt. Okay. And that's the reason it is not taken into account. Okay. So again, multiplied by 10% is equal to 9 crores. This is going to be the net income. On that, I'll have to multiply with the tax rate of foreign company, applicable surcharge and the cess, and get the amount of the tax liability. Okay. Now for CINC, 10(6)(a) benefit is anyway not applicable, because your agreement is after the specified date. Now here you have to understand the calculations very much properly. Okay, and here the students are likely to do lot of mistakes. Okay,